Welcome to Stock Insights. Today, we're diving into INNOVAGE Holding Corp., ticker INNV on NASDAQ, the leading provider of PACE healthcare for seniors. Is this small-cap stock a hidden gem or a risky bet? We'll cover its pros, cons, financials, and whether it could hit $1,000 per share. Let's get started. First, what is INNOVAGE? Founded over 35 years ago, INNOVAGE delivers all-inclusive care to frail, dual-eligible seniors through the Program of All-Inclusive Care for the Elderly, or PACE. This means comprehensive medical, social, and home-based services to help seniors age independently, avoiding nursing homes. They're the largest PACE provider by participants, operating in 6 states: California, Colorado, Florida, New Mexico, Pennsylvania, Virginia. They have a market cap around $500 million, serving primarily frail, dual-eligible seniors with capitated government payments. Let's break down the pros and cons. On the plus side, INNOVAGE is a market leader in a niche but growing senior care sector, but there are red flags: ongoing losses, regulatory history, and heavy reliance on government payments. Next, we dive into the financials, margins, debt, and stock performance. Now, let's talk numbers. Their latest earnings showed revenue up 13% year-over-year to $218 million in Q3 2025. Growth was driven by higher enrollment and better cost controls. Profit margins are a weak spot. Their gross margin is around 18%. Operating margin is negative at about -2.9%. Net margin around -3.8%, improved slightly from 2022 but still negative. They lag competitors like Ardent Health, which posts a positive 4% net margin. Margins have been volatile, with net margin dropping 34% year-over-year in 2024 due to high medical costs. High medical and care delivery costs pressured profitability. On debt, they owe $113 million with debt to equity about 0.38. They hold about $102 million in cash. Assets exceed liabilities. Operating cash flow of $26 million covers interest, but free cash flow was negative in 2024 at $45 million. Almost all revenue comes from government capitation, nearly 99% from Medicare and Medicaid. Side incomes are negligible, less than 1% or about $0.5 million a quarter. Since their 2021 IPO at $21 per share, the ride's been rough. Shares trade around $3.70, roughly an 82% loss since IPO. Compare that to S&P 500, up 85% over 5 years, a clear underperformance. They've faced regulatory hurdles, including CMS sanctions that were lifted in 2023 after prior issues in California and Colorado. Ongoing stockholder lawsuits and potential future sanctions remain material risks. Any policy change to Medicare/Medicaid rates could hit revenues hard. Quick recap: revenue growth, negative net margins, manageable debt but volatile cash flow, and near-total government dependence. What's next? Analysts project revenue could hit $929 million by 2026, with EPS turning slightly positive around 11 cents. Aging demographics are a tailwind, and policy support for home-based care could help pace growth. But major risks remain. Medicare/Medicaid rate cuts, new CMS sanctions, or litigation could derail progress. Could INNOVAGE hit $1,000 per share? No. That would imply a $1 trillion market cap, unrealistic given losses and regulatory exposure. Investment verdict: short-term, avoid INNOVAGE. Momentum is weak and losses persist. Long-term, there's conditional potential if they return to profitability and expand, but risks are high. For stability, stick with broad indices like the S&P 500 or NASDAQ instead of a speculative small cap. That's it for INNOVAGE. Like and subscribe for more stock deep dives. What's your take on INNV? Drop a comment below and tell us which stock to cover next. Not financial advice, do your own research.